Good afternoon, ladies and gentlemen, and welcome to the Finsbury Food Group PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, all questions submitted today will be reviewed, with responses published on the Investor Meet Company platform where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO John Duffy. Good afternoon, sir.
Thank you very much, and thank you to everybody who's joining us this afternoon. Much appreciated for your interest in Finsbury. So, Steve and I will run through a joint presentation. I'll do a little bit of an overview and a bit of an update on the markets that we're operating in at the moment, which are quite an interesting time, as you can probably imagine. And then Steve will take you through all of the numbers and give you a perspective on both the P&L and balance sheet, and then I'll pick up some key strategic activity that we've got ongoing, as well as an outlook. So without further ado, for anybody who's new to the group, and apologies for those that do follow Finsbury quite well, I'll just give a brief overview. So Finsbury are one of the largest specialty bakery groups in the UK. We've got a very diversified, sort of products, channels, and geography. We've got a fast-growing overseas business. We operate in very large markets, so UK bread and morning goods, for example, would be in excess of £6 billion. So whilst we seem like a big company, relatively modest in the context of those markets. We have got a broad range of customers and channels, and those products are both ambient and also frozen, depending on which channel they're going into. So frozen typically into food service. We've got very diversified manufacturing facilities in the UK and indeed in Poland. And we tend to make specialist products in each of those bakeries. So we don't tend to make all of our products in every bakery and distribute them locally. So very different in that regard. And as well as having a very strong relationship in sort of retailer or label brands, we've also got a very strong brand portfolio with the likes of Mars, Thornton's, Disney, and Xbox, and all sorts of things like that. So think of us as a large specialty bakery group, number one in a number of sort of niches, such as celebration cakes or premium round cakes, etc. Okay, so just moving on then, this is just a kind of very quick overview of the year that's just finished. So I guess record performance in terms of sales, and yes, against a backdrop of macro headwinds that have been quite challenging. So the group grew by just under 14%, of which volume was just under 9%. So a good mix of both price and indeed selling more product. And that, as I said earlier, is a record year for us. If we look in a little bit more detail, we can see part of that strong recovery in food service was driving growth. So up 38% in the year, and indeed even stronger in the second half, given the previous sort of restrictions in evidence the year before. UK retail, which obviously benefited significantly during the COVID lockdowns, also up 7.1% as those lockdowns reversed. And our overseas division, which has continued to exhibit strong growth, growing by 27% in the year. So a really good sort of solid performance across most areas of our business. EBITDA, therefore, up to just under £29 million, profit before tax up to £17 million, and diluted EPS up 17% to 10.1 pence. So I guess the financial metrics following the strong growth that we've had there. In terms of strategic highlights during the year, the most obvious one was that we acquired another 35% of our Lightbody Europe, sort of was subsidiary, probably likely to buy the other 15% within the next couple of years as the founders of that business and our partners retire. And, we're seeing really strong growth in Europe, and we believe that we're going to see more of that growth, and we are very interested in continuing to support the growth of our business. And then just finally, post-COVID, full dividend last year, back on dividends at the moment. So the final dividend of 1.5 1.67 pence per share will be paid later this year in December, which brings us up to 2.5p for the year. Now, I'll take you through a lot of data now, but in essence, in summary, there's a lot of challenges out there, but we're well positioned once we get through some of these, macroeconomic headwinds and things stabilize a little bit. So that's the theme of a lot of what we'll talk you through over the next 45 minutes or so. So talking about our markets, the last couple of years, for those that followed us, I would talk a lot about COVID and the impacts that various lockdowns and restrictions have had in markets and channels. Of course, that's all behind us now, by and large, but we have got a collection of, sort of challenges which are coming together and driving an inflationary marketplace, which, of course, FINSBURY is doing its best to navigate through. So first slide is really just to kind of look at some of those macroeconomic factors that are at play at the moment. Now, for those who followed the story, things like labour gaps post the lockdown and easing, issues around transportation of goods post-COVID from abroad, or indeed some of the Brexit difficulties with imports and exports and such, are all things that you will have heard me talk about before, and indeed they're not new. I guess what is adding to the mix this time round since we last spoke is that energy prices have not just sort of remained high, they've gone even higher. And in large part, that's due to the Russian invasion of Ukraine and the gas implications for supplying Europe, and also some of the sort of soft commodities, particularly grain, flour and such, which of course have also been impacted by that sort of conflict as well. But in essence, you've almost got a perfect convergence of inflation driving factors, not seen from, for quite some time, and certainly not in my lifetime operating in food. So a pretty unique set of market conditions that we are currently working our way through. In terms of, trying to give you a sense of some of the changes that are happening, this is just looking at over the last couple of years, what's been happening with, CPI inflation. And indeed, what you can see is, I guess, what you all know, which is that inflation has been building fairly steadily over the last year or so. And most of that inflation, which is running, as I say, about 10% in the middle of the year, is coming from housing and household services, so including, of course, heating, transportation, again, heavily linked to fuel. And in number 3 spot in July, which is the last block there, you can see that food and drink represents about 1.4% out of that 10%. So food and drink is beginning to become a significant part of the overall CPI growth, and that is something that is projected to continue as some of the inflation that we've talked to you about begins to work its way through the total supply chain. Again, just looking at the market, a little bit of up-to-date perspective. So this is looking at supermarket sales for the 4 weeks up to the 7th of August. And this is just give a little bit of a snapshot. I mean, overall, that market's growing at 1.1 percentage point value. That's driven, in fact, largely by inflation, which is 9.9%. A little bit of frequency of shopping as well, 1.1%. People shopping more fascias, so you start to see some of the consumer changes coming through. And indeed, own label doing very strongly within that as well, up 7.3%, tends to do well in recessionary or value-orientated times. And then what's moving the other way, on the negative side, volume down 5.4%. Post-COVID, of course, supermarkets benefited hugely from increased footfall as people were not able to eat out of home and socialise out of home for large periods over the last couple of years. And the supermarkets or grocery market in total gained about £6.5 billion of additional sales over the last couple of years. So, of course, that's inevitably been unwinding over the course of this year. And you've got a little bit less range and a little bit of less new product development and volume on deal. So you can start to see some of the drivers that are happening underneath that fairly low growth, 1.1%. And then one of the things that we're particularly interested in, and I guess most consumer-facing businesses are, is if consumers are feeling more constrained in their sort of financial position, where are they likely to tighten spending? So this was a piece of work conducted by Kantar just recently, and asking people to rank where they would cut back, and these are the areas that they indicated that they would cut back, and the relative degree of choice that each of those had. And what you can see is no surprises on the left. Luxury goods, 73% of people said that they would cut back in luxury goods, all the way through to, on the right-hand side, 23% of people who said that they might cut back on insurance. So gives you a feel for the sorts of levers that people will change in terms of their behavior of spend. For us as a food company, what you can see is second from the left, people will look to reduce their out-of-home expenditure in restaurants, coffee shops, and the like. And on the second from the far right, you see that food shopping, only 30% of people said that they would actually try and cut back on their shopping of food to take home and consume. So it gives you a little bit of a feel for how people might respond, and indeed how our own business might be affected both in the out-of-home channel and indeed in the retail grocery channel. And just looking back to the last recession around 2008, 2009, we also noted a number of consumer changes to behaviour, which I think are probably likely, and indeed probably are being seen already this time round. So more cooking from scratch, more efficient, allows people to turn on the oven once rather than several times. Families eating together more, and I guess if they're eating out less, then they are by default likely to eat more together. More people taking sandwiches and other things to eat out of home, so preparing them in home, maybe taking them to work, school, or the office for consumption at lunchtime. And more people making sure that they use up leftovers rather than simply throwing them in the bin and starting again. Other sorts of behaviours that we saw last time round, snacking tended to rebound, so people were looking for small treats, a little bit like the inexpensive lipstick, which makes you feel better, as an example. Last time round, health was less important as people prioritised financial situation over health preferences. Be interesting to see whether that is the case post-COVID, or whether health continues to be a more important feature of people's shopping behaviours. Enjoyment and feeling full and satisfied becomes more important, and also people are more likely not to take risks with choosing things that they may or may not like, so probably going to stick with things that they're sure they're going to enjoy as they spend their money. And then, just pausing for a moment, a question that, everyone is quite rightly asking is, well, what does all of that mean for Finsbury? So how well placed or otherwise is Finsbury? And I think, having given this, quite a bit of thought, I think Finsbury's not in a bad position. And why do I say that? Well, food is naturally defensive. So as you saw from propensity to cut back, food's quite low down the agenda. Everyone has to eat and drink, of course, and affordable treats provide a little bit of a lift in difficult times. Looking at the bakery sector within food, it is relatively inexpensive per calorie. So if you consider, buying bakery products versus buying your fish or protein, then clearly it's a lot cheaper to buy bakery products as part of your diet. We've got a very broad and flexible set of products within what Finsbury sell, and they can be used for virtually every daily occasion, whether it's breakfast, mid-morning snack, lunch, afternoon tea, indeed dinner or tea, or even some toast before you go to bed. So we've got a very, very well diversified and useful set of products. Now, Finsbury's, pretty well spread in terms of its customer and channels. Some of our customers will probably do better during a recession than others. We recognise that, but the thing is, we do business with everybody, so it should balance out in the round as we go through this. Own label, which is a big part of our business, as you know, is in structural growth and has been for some time, and that's likely to accelerate during recessions. It has done in the past. And then in terms of looking at our ranges, clearly out of home will be impacted as people choose to eat more in home, and we have a chunk of our business, about 20% of our UK bakery business is out of home. But within that, we also have areas like education, which is going to be relatively resilient with a young population, eating at school or university. We've got a lot of great value products, everyday treats, particularly within the sweet side of the business. And quite a big chunk of our business is kids' celebration cakes, which is licensed. It's an emotional purchase. And, mum and dad, during previous recessions, have tended to still make sure that they're able to give their child their favourite cake as part of their celebrations. So I would say that we're a well-invested business. We're an efficient scale competitor. We've got a very strong balance sheet, which I think is important given the uncertainty that's out there at the moment. And I think all of that should see us through these recessionary times and emerge a little bit stronger on the other side. Now, just looking at the year that's just finished, we tend to always include how have we been doing in each of our main markets, and where we have it, a little bit of a context for how the overall market has been doing. So it's a robust performance, I would say, on the left-hand side, looking at retail bread and morning goods, growing over that period at just under 4%, market up just under 2%. Good growth in some quite nice areas like artisan breads, etc., coming through strongly there. Our retail cake business up 5.5 percentage points versus a market up about 7.3. Good performance from us. The reason we're a little bit behind the market is because a lot of that growth came in the snacking half of the cake market, where we don't tend to play that hard. So we're much stronger in whole cake and celebration cake, which didn't enjoy such strong growth during some of that period. Food service bread and morning goods and our food service cake businesses both, bounced back really strongly. So you can say up by 1/3 and up by over 1/2 respectively there. And then finally, our overseas market, as we said earlier, growing strongly, up over 26% during the course of the year. So a good performance, very solid and very well spread across all the areas, which is great to see. Now, usually get asked this question, how well diversified is Finsbury? Is it overexposed to particular customers or channels? So this is a kind of chance to really just give you a feel for how the business is split. So starting on the left, you can see that firstly, about half of the business is cake, and the rest is largely bread. And about 14% of the group's sales are overseas, and that's up quite strongly from about 10% a few years ago. If I just go to UK bakery and take out the overseas piece, just to give you a clear perspective there, you can see that 80% of our sales are into the retail grocery channel, and as it says there, about 20% are into food service. That's up from about 16% for the previous year, as the lockdowns and such were effectively reversed. And again, just over half of those sales in cake and the other half in bread and morning goods. And then finally on this slide, we give you quite a good view here of how our UK bakery sales are broken down by customer. And you can see we do business with pretty much everybody that you might have expected. We trade pretty much in line with Tesco's market share. We overtrade with some people such as Waitrose and the Cooperative, and we undertrade with some people such as Morrisons and Asda, for example. Big in food service, big shares with Brakes and Bidfoods, who are the two largest food service wholesalers in the UK. And we do business with the discounters, albeit they have a limited range. And as a specialty bakery, we can only put a very small part of our range into their relatively small square foot stores. But in essence, we do business with everybody, and I think that's one of Finsbury's key strengths strategically. So I'm now going to hand you over to Steve, who's going to take you through the financial performance and the balance sheet, and then I'll come back in a few moments to talk about some of the strategy aspects.
Thank you, John, and good afternoon all.
The financial summary here, the dynamics faced by Finsbury over the course of the year, there are two major themes coming through. One is the post-COVID recovery of volumes, and indeed in particular in areas like food service, where in the second half of the year, volumes were up 50%. But the second dynamic, as you all know, and as from that earlier graph that John showed on inflation, is the onset of quite significant inflation during the course of the year, led initially by energy, gas and oil, but then it was across all parts of our business, whether it be raw materials, whether it be labor, or whether it be overheads in general. And these two dynamics actually play their way throughout the first and the second half of the year. At the end of the year, our revenues are up just under 14%, 13.9. That's up 43.5 million pounds to 356.8 million. We do give the split of that between volume and price. The volume element of it is just below 9%, 8.7, and the price recovery is 5.2%. And the important point is the onset of inflation during the first half of the year was responded to by a combination of events, but ultimately price increase is important, and price recovery occurred, and that benefited more so in the second half of the year than it did in the first half of the year. Gross margins of the business for the full year down 0.5% to 32.4%. I mean, the second half of the year is an improvement on the first half of the year, and again, it reflects the recovery of inflation in the second half of the year, primarily through price increase. The operating profit at 17.8 million is up 1.7 million from the previous year, or 10.6%, and that dynamic does really reflect two halves. The first half year operating profit was 6.5 million. The second half was 11.3 million. You can see that momentum coming into the second half of the year and in the impact on its operating profit. The operating profit margin slightly down 5.1 to 5%, so it's down 0.1%. That is a dynamic driven by this first half, second half, but ultimately, if you think at half year, our operating margin was 3.9%. You can see that leverage coming through into the second half. Earnings before interest and tax, depreciation and amortization, 28.7 million is up 1.8 million. It's a key metric that we use. It's equivalent to cash earnings. So that's at 28.7 million. You'll see that figure come through in the cash flow statement. Profit before tax increased by 1.9 million to 17 million, an increase of 12.1%. Similar figure in growth for operating profit, EBITDA or PBT. That's all growing by roughly the same figure because they all reflect the same dynamic. And ultimately, if you are seeing growth in profit before tax or indeed profit after tax, you will get a benefit in earnings per share. And the earnings per share increased to 17.4% to 10.1 pence. Bank debt increased from 13.1 to 20.6 million pounds. There are some very key dynamics to that, which I cover on the cash flow slide, so I will leave that to that slide. Our business is in two sectors. We have the UK bakery sector and we have the overseas sector. The dynamics of the UK bakery sector are effectively the same as that for the group. So all the commentary I've given so far about inflation onset and the recovery of that manifest themselves in the UK bakery sector. So the growth of revenue to 306.7 million is a growth of 33 million pounds, or 12.1%. And the gross margin element of it stayed relatively stable in the period, as it shows that we did recover at gross margin level sufficient to keep it at flat. The operating profit grew by 1.3 million to 14.9 million, so a growth of 9.5%, and the operating margin a slight decline from 5 to 4.9, a decline of 0.1%. Whereas the overseas business saw substantial growth, going from 39.6 million to 50.1 million, a growth of 10.5%, or 26.6. The overseas business is really an extension of the UK business in so much as what is driving that growth is celebration cake. The celebration cake in particular in France and in Benelux
This celebration cake is a category that is new to France. It's new to in-store bakery in France. It's in substantial growth, and we are the only players in that, and that is underpinning that revenue growth. There are all other sectors in that, albeit they are smaller, are also in growth. So that business is a good business model, and is the reason why we increased our interest in it from 50 to 85%. So an increase of 35%, and you can see the cash flow benefit of that in a second's time. Decline in gross margin in overseas is primarily driven by the way the French retail sector works. For those of you who've had exposure to it, there is only one opportunity each year to change your prices on the negotiation of contracts, which occurs February, March. But yet the UK, which made those products and sent them across to France, we put our price increases through a few months before that. And that in that period, intervening period, they couldn't adjust the prices with retailers, and hence the reason why the gross margin has reduced by 2.6%. Nonetheless, the volume leverage has resulted in operating profit growing from 2.5 to 2.9 million, an increase of 16.8%. And the same dynamic affecting gross margin. It's not as bad, obviously, because there is the operating leverage of the sales out business, but there is a decrease of 0.5% from 6.3 to 5.8%. The cash flow, and really we're focusing on the extreme right column. The EBITDA, as I said earlier on, is the base point for this. The big movements in the year will be the only ones that I cover. So working capital movement of 2.5, that's an absorption of working capital. And that reflects the growth of the business in the second half. I said to you earlier on that food service grew by 50%. That does have an impact of working capital. It absorbs it, ultimately in debtors, but it may also well be in stock in advance of the year end and what happens in the subsequent months. There has been no dynamic change in working capital, whether it's the terms we have with suppliers or the terms we have with customers. That is just a reflection of activity in the final months of the year. CapEx at 12.5 million is obviously a bigger figure than 6.2. A lot of that is driven by capitalizing on government grants at 130%. So we did accelerate CapEx to get those super allowances. And a big element of that is a new line in buns and rolls line in our Sheffield factory. 6 million of that relates to that one single event. It's about to be commissioned in the next month or so, and it will deliver an incremental capability of the business of about 11-12 million pounds worth of revenue, which we believe we will fill relatively quickly. From a point of view of maintenance CapEx, the bare minimum, if you ever wanted to cut to the bare minimum, that's about 4 million pounds per annum. We've never gone anywhere near that. Don't intend to. That's not the business model that we have. We continue to invest in our business, and our focus will shift over the course of the next year or so, more towards profit, cost reduction initiatives, automation, and that will be obvious considering the inflationary environment we have at the moment, and labour being inflationary in its own right. Interest, there's no point to make there. Tax, the reduction of the tax from 3.9 to 2 is a number of one-offs in there, 3 of them. The main one is the super allowances that are referred to you earlier on, about 0.5, 0.6 million. Other ones are that the research and development tax credits that we get, you do it every year. Last year there was none received. This year we had 2 years worth received, and that's worth about another 0.5, 0.6. And those are the 2 major ones affecting that cash flow. The free cash flow is therefore 8.8, largely driven by the increase in working capital, and the reduction of it driven by the increase in working capital and the increase in CapEx. The minority dividend is important to flag. We bought an extra 35% of the Lightbody Europe. That's from the founder shareholders, and the pre-acquisition dividend, we distributed all reserves pre-acquisition, and the bit that went out to them drives that increased dividend. 1.4 million of it is pre-acquisition. This acquisition has been accompanied by us over the course of the last 3 years, putting in a new managing director. So this new managing director is working together with the existing managing director, or now the founder shareholder. As they wind down in the next 2 years, there is a formula for them exiting, which is 6 times earnings. So in effect, we're keeping them in the business so they keep on driving it forward, and they work together with the new managing director, who I think is doing a great job. and in less than 2 years' time, we will exercise the option for the existing shareholders to leave, or they can exercise it as well. It works both ways. Free cash flow after the minority dividend is 6.3. Dividend paid in year, a normal dividend at 2.5p costs about 3 million. But this year, because of not having a dividend in the year during COVID, we paid a full and final one, all in one go at the beginning of the year in December. That was £3 million or 2.4 pence. And then the interim on the current year is the £1 million. So that adds up to 4. But normally at this level of dividend, you would expect only to see 3 million in that column. Shares in times when the share price was low, we bought shares and put them into the Employee Benefit Trust. This is to meet share-based remuneration commitments. We've got more than enough in there at the moment, so we don't need to do any more. But that's what happened over the course of the last 2 years. The acquisition consideration includes the £6 million paid for the Lightbody Europe business. It was based on a multiple of 6 times, which is a perfectly good multiple for a growing business. And the exit multiple of the remaining 15% will be on the same formula. And then the final item there is a significant non-recurring item. We actually did have a transaction which we were looking at, which was quite transformational, a similar sized business to us. At the time, it was based on a share price for FINSBURY of about £1. During the course of the last few months, the share price has declined to the 60, 70p. That rendered the transaction very difficult to do. It hasn't gone away. Both parties are interested in doing it, but we need to get all the planets in a line before we are able to get that one across the line. And at the moment, there is nothing happening on it. But ultimately, that resulted in a decrease in debt of 7.5 million, with the two biggest dynamics, CapEx and the change in working capital, and also the acquisition on top of that, which is the point I make on this last slide. So we've got a very strong balance sheet, very low levels of debt. The debt increased as a result of the acquisition of 6 million, paid £6 million in the pre-acquisition of dividend of 1.4. The CapEx growth of up to 12.5 took debt up by 7.5 million to 20.6 million. As a multiple of EBITDA, it's less than 1 times, which is very healthy in an environment such as we have at the moment. We have nonetheless entered into new banking facilities. They were coming to an end, and we thought it was important to do that a year out in advance. We have a new £120 million facility, which, if you consider it, we're currently drawn down about 20. We have a lot of firepower if we want to do M&A activity. And that gives us the flexibility that we need as a business. On the right, just a couple of admin tidy up points. There is a defined benefit pension scheme in one of the subsidiaries. It's very small, and the increase in the discount rates from 1.95% to 3.85% has driven that reduction in the deficit to 6.6 million. So that's now a very small, a relatively small figure. There's an actuarial valuation in progress on that, which is coming up with figures at similar levels. And the annual contribution that we pay into that pension deficit is 760. And that is not going to change even as a result as we finalize the actuarial valuation, because we've already agreed that with the trustees. And then finally, you have the significant non-recurring item, 1.9 million cash flow in the year related to the aborted acquisition and litigation costs, where we have a litigation in process at the moment with a previous warranty claim that we are making. But that should work its way through in the next few months and won't be a factor in the coming year that we're in. And that's it from me. Back to John.
Thank you very much, Steve. And so just kind of a little bit of an overview in terms of the strategic update we've been doing. So most of you will probably know our strategy by now. We've kind of regrouped it under 3 headings in line with sort of tidying up some of our communication. So the 3 strategic pillars really around excellence. So investing in our people and our business and skills, and innovating and following consumer trends. Growth. Ultimately, business is a lot about growth. So driving growth, both organic and potentially acquisition, which the group has got good experiences. and targeting our growth in as many channels and indeed the UK and Europe, and doing that with our strong licensed brands as well as our strong retailer brand relationships as well. Got increasing focus, obviously, under responsibility in making sure that we've got the right commitments and sustainability coming through. So that's people development, engagement, mental health and well-being, which particularly a strong focus now as people have been under quite a lot of challenging conditions for COVID over the last couple of years. And we continuously strive to reduce our impact on the planet and make sure that we're doing everything we can in terms of our environmental footprint. So I guess nothing revolutionary there, but maybe I can just take each of those in turn now and point out to a few practical things that we're doing which might help bring it to life a little bit. So in terms of excellence, we've got an Operating Brilliance program running now for about 3 or 4 years, OBP as it's there, very much about improving our operational capability, our people, our business processes, and also our equipment and line processes as well. So building resilience and continuous improvement in terms of performance. During the course of the last year, we saved over £4 million gross in terms of projects that were driving efficiencies, reducing waste, etc. And a lot of our ability to do that has been improved dramatically by the major investments that we've made over recent years in our IT systems, which we've done pretty much across the whole group now, barring one last acquisition, which we've got to finalise. And then, during the course of the year, we've invested and indeed are still rolling out in some instances 3 new systems, so worth maybe just giving you a feel for those. So a new supply chain planning system, a new product lifecycle management system as well, and a group-wide computerized maintenance management system. So you can kind of see it's all about bringing our skills and knowledge, putting it into systems that are on the cloud, up to date, easy to use, give great information, and allow people to actually make better business decisions and improve the things that we do. We've got over 3,000 people, so we're investing in a new HR system during the course of this financial year, which will improve our ability to match training, skills, and all of those sorts of things with individuals better. In terms of growth, I guess maybe the best example would be our European business at the moment, where we're working really, really strongly within our Lightbody Europe celebration, small cake, and free from categories. And we're seeing the rollout of more and more of those licensed brands and strong innovation pipeline driving that top line growth that we talked about. We've also got, I guess, quite a lot going on in the UK. Our food service business has bounced back really strongly. That's in large part because we've worked really well with our large customers in food service to try and help them through what's been a very difficult couple of years and to get ready for the bounce back, which has now happened, but also some of the challenges that are out there at the moment. So a lot of work going on in that area. More capacity coming in. So we've got a new buns and rolls line that Steve referred to, our Sheffield facility. And we've also got some capital investment in capability in our celebration cake business. And they should help underpin growth organically over the next couple of years. And there's a few examples of products down there on the bottom of that slide. We've got 3 of the top 5 celebration cake lines in the UK market. And the Xbox product that we launched some time ago now is the fastest selling growing cake in the marketplace. And we've also got a very strong gluten-free business, particularly in bread and morning goods, but also latterly in cake. And we're seeing double-digit growth there. We're also extending our Weasel Free From brand out into a number of European markets. Finally, in terms of responsibility, so our kind of primary focus is to make sure that we can develop people's skills, that we can bring in the right subject matter expertise and develop that. We've got excellent sort of programs within the business now over the last 5 years or so. Graduate talent, graduate recruitment programs, good apprenticeship programs. And we've got some very good leadership development programs as well. And indeed, some of our new appointments to the board have been homegrown talent that we've brought through the business. So really good to be able to see that happening. Diversity inclusion, we've got over 30 or indeed 40 nationalities at some of our sites, so it's really important to us. So formalizing and improving, our policies, our campaigns, and our ways of getting people to develop awareness and understanding and work better together. And as I mentioned, health and well-being, really, really key. We've got over 50 mental health first aiders in the business now, which is, really, really helpful for, particularly people working shifts and having all sorts of challenging things happening in their lives. Jump on now from that slide in the interest of time and just move towards the outlook. So Finsbury has had good evidence of strong organic growth. So that continues to be a theme for us. So where we've got products in one business that we believe we can, one factory rather, that we can sell into new channels or into other customers, etc. That's clearly a great opportunity for us. Good examples of that, I guess, are licensed celebration cakes, both in the UK, but also into Europe. Artisan breads, which is a market that's been growing very strongly, and we've got a very good offering, and indeed free from. So lots of organic growth opportunities, which we continue to, to sort of push quite hard. And as Steve mentioned, acquisitions. So we did, try to complete a large acquisition during the period. Fortunately, market conditions moved against us, so that didn't happen. But those market conditions may well move back to be more favourable, particularly if we find that there are some businesses that change their view about their valuation, or indeed need some assistance during will be quite a challenging market conditions for many people over the next little while. So any acquisitions we do, just to be absolutely clear, they've got to meet our returns criteria or we won't do them. And we've got very strong banking support, which I think is is absolutely key, given that markets are also, from a banking perspective, more challenging now than they have been in recent years. So just in summary then, before we turn to some of the questions, I would say to you that Finsbury is well positioned once the macroeconomic situation stabilises, and I do absolutely believe that. I think in the short term, there's a very complex mix of variables happening out there, which we have limited control over in terms of commodities and energy prices and such. So it's difficult to make exact predictions because consumers are changing their behaviours as we speak. So we've got great products, but of course people have got to be able to afford those products and want to buy those products. We've spent several years already investing significantly into the business, diversifying it, unifying it, optimizing it, developing people and systems. So we're well set for these tougher times, I think. We've got a growing momentum, in particular in our Operating Brilliance program, and we'll look to continue to see similar levels of savings in the next few years that we've managed to achieve in the last year, which was over £4 million, if you remember. So I think we've got a proven model, and we have been through some pretty difficult years with COVID and with Brexit and other various challenges to prove that. We've got that strong track record of dealing well with adversity, and I think that will stand us in pretty good stead as we emerge as a stronger business through this. And our longer term growth prospects, I genuinely believe, are as robust as they've ever been, particularly as we add new capacity. We see really strong growth outside of the UK as well as inside the UK. So that's the end of our formal presentation. And I'll now, with Steve's help, have a look at some of the questions that have come through and try and pick off some of those as we can. So I can see...
Sorry, John, Steve, if I may just jump back in there and give you a moment, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while Steve and John take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. John, Steve, as you can see, we have received a number of questions throughout today's presentation. So thank you to all of those on the call for taking the time to submit their questions. And if I could just hand back to you to run through that Q&A tab and respond to those questions where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Thank you very much. Getting a little bit ahead of the game there. So first question I can see from Tom M is how fragmented is the specialty bakery industry? Who are the nearest competitors, and would you look to grow the business through being a consolidator in the sector? I think, to be honest, Tom, that's a very broad, question. We have a lot of big and small competitors. It does vary depending on which product area we're looking at. So very different buns and rolls from celebration cakes, etc. So I guess my general answer would be yes, where competition authorities allow, we would be interested in consolidating some of those areas. Particularly, in tough times, it may well be that there's a good incentive to actually look for synergies and efficiencies from bigger scale. So that is something that we will continue to look at. We have looked at a number of potential acquisition opportunities over the last few years, but as yet we haven't found one at the right valuation expectation that we were prepared to move forward on. The next question I can see is from Sammy. Do you have any plans to increase the number of manufacturing sites, either here or in Europe? I guess, Steve, that's probably an easy one to answer.
It's a no and yes. So organically, we won't be investing in additional sites within. Our existing sites have more than enough capacity to manage increased demand. I think if we do acquire additional sites, it will be through M&A activity. Invariably there will be a manufacturing site associated with the business that we'd be looking at.
Super. Thank you, Steve. Okay, so fairly good question here, which I think is worth sort of spending a couple of minutes on. So from I think Sammy, how have price increases been received by your major customers? So I guess the last sort of 12 months or so have been very much about responding to the significant cost inflation that's affected everybody really in most walks of life, and certainly the food sector. So I would say our customers, a lot of them are quite big. They're very capable of pushing back quite hard. But what we've seen really is that customers genuinely understand what the inflation is. We're quite transparent by individual product area as to what the costs were and what they are now, and why we need to incur a higher price for our goods. And we've generally agreed those price rises. So yes, they take time, they take effort, but they have been successfully achieved. I think, in fairness, we're now at a stage probably where, as well as price, we're also sitting down with some of our key customers and looking for ways about how we might be able to take some cost out of our supply chain, which might involve them making some changes, perhaps in the way they order or in the way they receive our goods, how many boxes we can put on a pallet, for example. More boxes on a pallet means less movements, less storage, etc. So we're in a phase at the moment. It will always be an element of tension, but as you can see from last year's results, our customers, they need our products on the shelves, and equally, we need them to sell our products. So challenging at times, but in essence, we usually agree what needs to be done, and increasingly we're kind of trying to find ways of taking cost out, rather than just arguing about the inflationary costs, which are real and transparent to everybody. Next one from Nick S is, what European countries do you operate in? Do you bake in Europe? Maybe pass that one to Steve.
Yeah, so we operate, our big businesses in France, but also Benelux, both Belgium and Netherlands. We have a manufacturing facility in Poland, and obviously therefore the Polish market is another market we sell into. And then to a lesser degree, we do have a sizable bit of gluten-free business in the Scandinavian countries. But the big ones are France and Benelux.
Okay, so thanks for that, Steve. So you've got a long question here. James, Thank you for the informative webinar. Thank you. Congratulations on a strong set of results in challenging circumstances. My question is whether you will add a broker in the near term who will make your research available to the private investor community, either direct or via sites such as Research Tree, to aid investor understanding of the company, its progress and prospects. James, that sounds like a very heartfelt kind of communication. You're right. I think in recent years, some of the new European legislation, like MiFID II, has made it increasingly difficult for brokers and analysts to share their research with people that they don't have a kind of commercial agreement with already in place, and that is quite frustrating. I guess it's partly why we're doing activities like this and why we include, I think a very strong set of results, a very strong annual report, and indeed our investor presentation and such on our website. But I think we'll kind of take that on board. It would be great to get more research available. There is paid research, as many of you will know, but I think paid research never feels quite the same as independent research. So I guess that's one thing that we may choose to reconsider. Okay, I think if I've managed to get through them all.
John, Steve, absolutely. If I may just jump back in there, and thank you very much indeed for taking the time to address all those questions that came in from investors this afternoon. And of course, if there are any further questions that are submitted today, we'll make these available to you immediately after the presentation has ended for you to review, and then add any additional responses where it's appropriate to do so. John, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, certainly. Thank you. So firstly, thanks for tuning in. Thanks for taking an interest in Finsbury. I guess the marketplace is very different from what all of us probably expected, but it is the marketplace that we find ourselves in. I think what we would try to communicate to everybody really is that we do something quite unique. Specialty bakery is something that everybody sort of needs and wants. It's going to be there, in the longer term. So demand is not going to disappear. It changes shape a little bit over the next little while. But our strategy has been to kind of really take a long-term view of the business, investing in the people, investing in facilities, investing in the systems, going for organic growth, buying the occasional business when we feel it's the right time and the right value, the right risk profile. So we're going to continue to do what we've been doing, what we've said we will do. And we think that we've got a business that will come through these recessionary times in even better shape than it's entered into them. So we can't change the markets, but we will keep doing what we do. And we believe that it's a business that everybody is going to want and need in the longer term. Thank you very much for listening.
John, that's great. And Steve, once again as well, thank you for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Finsbury Food Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.